And this is the Sarasota Technology User Group for Wednesday, April 6th, 2022. I'm Huey Poplock, your host. This evening, we're going to have a meeting with a program called Prudent Investing in a Post-Pandemic World by Dr. Robert Stepleman. Just a few things before we start. At the end of the meeting, if you're still on, you would be, and you are a member of STUG, you're eligible for a drawing where we draw one member's name. If you're still online, you'll win a renewal membership for 1 year in STUG. We have classes and forums. They're limited to our current STUG members only unless otherwise noted. This month, we have the Windows File Management by Marcia Berkey on Thursday, April 21st. All levels of experience are welcome. In this class, you will learn the basics of using Windows Explorer. Have you ever downloaded a file, then don't know where to find it? Have you ever tried to find a file that you know that you have, but you can't find it? In this class, you'll learn how to use Windows File Explorer to create a hierarchical folder structure, as well as how to move, copy, rename, and delete and search for files. To register for the class, you need to send an email to Marcia a couple of days in advance. She did another meeting on YouTube today. The STUG Help Desk is scheduled for the third Wednesday of every month. You have a technology question to ask our tech-savvy people. Maybe you'd rather sit and learn by listening to others. The next meeting date is April 20th on Wednesday from 4 to 5:15 p.m. Sign up for the meeting reminder with the link, and that link is also on the website as hosted by Jim Cerny. And be sure you register, and then he'll send in a reminder with the link to the meeting. To register for the STUG workshops, there are two methods. Either you send an email to the instructor, or there might be a link provided in the member reminders to register for the class. I'm a co-host with Ron Brown. We do Tech for Seniors every Monday from 11:30 to 1:15 Eastern Time. It's on Zoom, but it also streams to YouTube. Last week we filled up, and the overflow had to go to YouTube. We feature resident experts Bob G., who's on with us today, Ray Baxter, Dewey Clues, and Bill James. STUG members are invited to attend this action-packed hour. We talk about all kinds of things about technology for an hour. It starts at noon Eastern Time, runs till 1, and then we have a Q&A at the end of it. We also do a Tech for Seniors live on Thursdays. Actually, it's from 12 to 1. We stream it on YouTube and Facebook. It is not a Zoom meeting. You go to YouTube or Facebook and you find it, and you watch, and you can chat with us and ask questions and make comments. Also, I do a Windows Special Interest Group for the Central Florida Computer Society, and all of you are invited every second Sunday, which is this coming Sunday, from 1:30 to 2:45. That'll be on April 10th. And we talk about Windows 10, Windows 11, and some tips and tricks about Windows and computers in general. Go to huey.net, sign up for the newsletter. It hasn't been sent out yet, and you'll have a link in there on how to register. Don't forget the STUG website at thestug.org. Our newsletter, if you're a member, you get the newsletter sent to you in PDF form. We have a YouTube channel where most of our meetings are recorded and posted, and there are some other really good videos up there. Make sure that you take a look, and then you like and subscribe so you get notifications. We have a Facebook page, and we also have a question and answer forum called the STUG groups.io, and you get information. All you have to do is to subscribe. You send an email to the STUG with the +, subscribe@groups.io. Here's our board of directors. And Ann will introduce our speaker.
She's on her way.
Okay.
How do I get back to my screen now?
Okay, I will stop sharing, and then you will share your screen.
Okay.
Thank you. Thank you very much, Huey. Prudent investing in a post-pandemic world. Wow. Well, the combination of COVID pandemic volatility, rising inflation, and interest rates have shaken investors' confidence in their investment strategy. This has caused some to consider speculative investments like Bitcoin and NFTs. How many of you know what an NFT is? I do. It's a non-fungible token.
Very good.
How about that? Dr. Stepleman will review what's going on and discuss prudent investments in the unsettled times that we are in. As its Chief Portfolio Strategist since 2013, Dr. Stepleman lectures and conducts seminars for Dow Wealth Management. Since 2000, he has written a weekly column on portfolio strategy for the Sarasota Herald Tribune and others that appear both in print and on the internet. He has lectured widely on practical methods for balancing portfolio risk and return. He espouses the view that investing success starts with portfolio design and ensuring that for each investment, the potential reward justifies the risk taken on by making it. Dr. Stepleman offers securities through Boston Global Capital, which is in Bolton, Massachusetts, which is right next door to where I grew up. A member of FINRA and SIPC, Dr. Stepleman is an SEC registered investment advisor. So let's give a warm STUG welcome to Dr. Stepleman.
I want to thank you for putting up with me for an hour or so. I tend to be sometimes a little pandemic because of my background as a college professor. So you need to put up with me. One of the things I was most pleased was to see how many women had signed up based on the faces I saw before I went to my full screen, in which I can't see anybody now. The reason I am is women tend to be underserved in investing because historically men have run the investing advice and business and haven't paid a lot of attention to women, and women need to understand more about investing. The reason is 90% of women will have household finance responsibility at some point in their lifetimes. 90%. Over the last century, the number of households headed by women has increased from 18 to 23%. That's one reason. Other reasons, which some of you unfortunately probably will know, is that women tend to live longer than men. And women of my generation, which is the same generation many of you there, tend to marry men 4 years older. And since women have a 3-year longer life expectancy, they'll tend to be widows for at least 7 years or so. And that's another reason why they would have household finance responsibility. Unfortunately, many of you will know 50% of marriages end in divorce. And the other reason, which I'll quickly mention, is because women are marrying men older than them. It's unfortunate, but senility, whether it's caused by Alzheimer's or something else, will likely hit the man before it hits the woman. And so she will have, again, household finance responsibility. So when you add that all together, it's not surprising that 90% of women will have financial household responsibility at some point in their lifetimes. So because of that, it's very important that women understand the basics of investing and they understand what's realistic. The way I got started in this business was in the late 90s, I was asked to give lectures to women on how to avoid being chum for sharks, because every place in this world, wherever you are, there are people who are willing to take advantage of you. And even in sunny Sarasota, there are shady people. So, and you probably read about them if you read the Herald Tribune, about people who will Ponzi schemes. And there was someone not too long ago who was doing some sort of annuity business. And so one needs to understand what's realistic and what you should walk away from without even giving them a time to talk to you. So what I'm going to try to cover here in an hour as basics of prudent investing in a post-pandemic world. A lot of things have changed because of the pandemic. You're all aware of some of them. That is, interest rates have been going up, supply shortages have been happening, the stock market has been behaving like a yo-yo. All sorts of things are going on now. So it's important that you understand how to invest prudently and what to avoid. And that's what I'm going to try to cover in an hour. I'll also cover some small advertisements for Dow Wealth Management as part of the presentation. Unfortunately, that's the price of entry into the presentation. So let's move along. Over the past 85 years, since 1937, the advisors at Dow Wealth, which is an 85-year-old company, not fly by night, have seen a myriad of ways to invest. My position today is to explain to you some of these different ways to invest, including these new quote unquote assets, like one of the nice ladies mentioned, NFTs. We're going to talk about the challenges and potential pitfalls, and then cover the key drivers of prudent investing that may allow a portfolio to work for you now and in the future. However, in today's complex world, prudent investing is more than a simple collection of bond payments or dividend income or staying away from the wrong kinds of investments. Prudent investments takes a team approach to get the best results. And it's not just about generating cash flow, though that's important. You need to do it in the correct way so you can build your wealth and have cash flow come from it, sustainable cash flow. And we'll talk about that. And keep in mind that prudent investing means always seeking to avoid an irrecoverable loss of principal. Irrecoverable losses come about in different ways. It can come about because you buy a low quality bond and it goes bankrupt, or that you buy a stock and it goes bankrupt. Because I think most of you are aware that when a company goes bankrupt, the stockholders tend to lose all their money. The company may recapitalize, but those are new stockholders. For example, you're all aware that General Motors went bankrupt, and here it is still on the stock exchange, but the stockholders who had General Motors stock before it went bankrupt were wiped out. It was then recapitalized with new stockholders. So that's one way you can get an irrecoverable loss. The other way you get an irrecoverable loss if your investments don't keep up with inflation. Because after all, what you're after at some point is spending money. And if you have only the money that you started with and inflation has been at, say, 3% a year for 10 years, then your standard of living won't be the same. So you have to avoid irrecoverable losses of purchasing power as well as irrecoverable losses of principal. Now, what I was indicating before is investing has become more complex because really to do it well, you need a team. The idea that a portfolio is an island, not affected by other aspects of one's financial life, is a concept that's outdated. All parts of one's financial circumstances affect the others. What you need is a comprehensive way to do this. Now, Dow does have a comprehensive way, and we'll talk more about that later. We call it a family office. The idea is, though, that you have lots of people that you depend upon for financial advice in one way or another. You have a financial advisor, perhaps. You have a CPA, you have an insurance man, you have an estate plan. If they're islands and not operating together in your best interests, you will miss out on opportunities. And I'll talk later about some of the kinds of opportunities you may miss out on if you don't have a way for them to work closely together. A combination of savvy investing along with useful and practical access to information critical to understanding an investor's overall situation is what makes the best things. And that means your insurance agent, your estate tax lawyer, your CPA, and your financial advisor have to know about each other and have to be able to work together. As I said, such a platform is available to our clients at no additional charge. That was the little warned you there would be a small commercial as part of the presentation. But let's talk about some current investing topics, then expand to a broader view of the investment landscape. Today, we'll address the challenges and potential shortcomings of these investment offerings, and then we'll summarize with our core prudent approach to invest, how to invest one's hard-earned retirement savings. I'm focusing here mostly on harvesting cash flow and lesser so on building your investment portfolio, because most of the time when I'm talking to people in the Sarasota area, they're either very close to or already in retirement age. But I will, for those of you who are still building, I will be talking a bit about that too. There are modern and different ways to invest your money. Some new investment choices have cropped up in recent years, and we've mentioned a few of them. Bitcoin, we'll talk about that and decide whether that's really something to invest in. And one of the ladies meant non-fungible tokens. For those of you who don't know what they are, I will briefly tell you what they are. So let's put our current investing environment into context so we can understand if Bitcoins or non-fungible tokens have any place in the investing environment. Okay, as we said, things have changed with the pandemic and supply shortages, and of course, the war in Ukraine. Inflation has surged recently, you all know that. You've all seen it in the supermarket. The prices of basic goods and services have climbed dramatically. Only restraint from the Federal Reserve in raising their benchmark rate has prevented interest rates from spiking more than they have. You might remember that inflation in 2021 was 7%, but most recently, the last number I saw for CPI inflation was 7.9%. And the way the Federal Reserve likes to measure it is PCE inflation, personal consumption estimator, and that's been raising between 5.4 and 6.4%, depending whether you want to take out food and energy. But by almost any measure you think of, inflation has become a problem. And it's especially a problem, as we'll see, for people who are investing their portfolio mostly in fixed income. So let's look at what's, sorry about that. Let's look at what some current interest rates are so that we can get some perspective from, suppose you had $1 million to invest. How much income would you get from current investments in fixed income? Well, if you went to a bank money market fund, online banks, not your local bank. I know when I go to my local bank, they offer me 0.0005% or something like that. But if you go to online banks like ING or some of these others, you can get 0.5%. So if you gave them $1 million, you'd get $5,000. If you put it in 1-year Treasury bills, one of the safest investments, you get about 1.77%, and that would give you $17,000 a year to spend before taxes and inflation. 10-year Treasury note, $26,100 as of today. 30-year Treasury bond, $26,300 as of today. The municipal bond index is paying about 3.18%, so that would give you $31,800, exempt from federal taxes. Investment grade corporate bonds, a little bit more, $35,600. And an illusionary number, perhaps, is the S&P high yield corporate bonds. You would get about 6.13%. And that would provide you with $61,300. However, there are caveats. The real return is what you should worry about, because if the prices of goods and services is going up faster than your interest and the income, then you actually have a negative real return. And that's what's happening here. After taxes and inflation, as I said, the CPI in 2021 was 7%. There is no real return. Even if we want to invest in high yield corporate bonds, but look at 6.13%, which is an illusionary number, but there is no real return. So you're losing money. Even though it looks like you're getting interest, you're actually losing, and that's before taxes, other than for the municipal bond index. And so if you're in the 25% bracket, 25% of that number in the right-hand column disappears to the government, which gives you even less to spend, and less even then after inflation. Now, high yield or junk bonds, the reason I call that illusionary is because they're called high yield or junk bonds because they have a higher default rate. For example, in 2016, according to Morningstar, let's see, that was Forbes actually, this one, was 5%. That meant that if you had $1 million of bonds, you might expect 5% of them to disappear in bankruptcy. And that would be $50,000 of your interest. The equivalent of your interest would be down $50,000. So the actual interest you get when you correct for the $50,000 of default that year would be very little. Of course, there's no telling whether your particular bond portfolio would have, or the bond fund you invested will have anything like that 5% default rate. But that was the number for 2016. So this is the problem with harvesting money from your portfolio. If you do it all with fixed income, like what we see here, you're going to have a hard time staying above water. And we'll talk more about that in the future slides. Now, interest rates averaged about 6% during the economically strong period in the 1990s. This indicates that higher interest rates are not incompatible with a prospering economy. And in a prospering economy, stocks will usually do well. Bonds may not, but stocks will usually do well in a prospering economy. Another thing to keep in mind about rising interest rates, which we're seeing now, is that a lot of people spend time with their advisors and they come out with a 60-40 portfolio that is 60% in stocks and 40% in a broad-based bonds. This year, that wouldn't have done you much good because this year, as of January through now, year to date, stocks have fallen, but bonds have fallen even more. So a 60-40 portfolio would not have helped you, would have even hurt you a little bit this year. So in future years, if interest rates are going up, the value of a 60-40 portfolio may be dubious, even though that's what many financial advisors focus on. Why has this happened? Why have we gotten to where we are now? Well, we can blame the Great Recession, the pandemic, and the Fed. What they've done is, until recently, they've started to think about changing it, but until recently, they've been expanding the money supply. They've been throwing more and more money in the economy. And what happens when you throw money? Most of you know about the law of supply and demand. So let's think about it. If you throw money into the economy, some of it will wind up going into bonds. And what happens when you put money in bonds and you have a lot of money flowing to bonds? Bond prices go up. But what happens when bond prices go up? Their yields go down. So you wind up getting less interest. On the other hand, what happens to stocks when you throw a lot of money in them? Well, the stock prices go up because there's more demand. And so stock prices go up. And so that's what we've seen over the recent few years. We've seen a tremendous increase in stock prices. Those of you might remember over the last few years, we've had the market go up. I think last year, the S&P 500 was up like 28 or 29%. And the year before, it was up like 31%. So the reason that's happened is because there's been so much money thrown, it had to go someplace. The money that went into stocks pushed up stock prices. The money that went in bonds pushed down bond yields. So bondholders had real problems if they were trying to live off the interest they could get from their bonds, where stockholders sat there fat and sassy because their stock prices zoomed ahead. Blame the Fed and the Great Recession and pandemic. That's how we got to where we were until now, where the Fed is now starting to raise interest rates and will continue to do so at least through 2023 and probably longer. So let's talk a little bit about things that you might have heard about that might pique your interest and that I personally, as Dow, feel that would be a bad thing. So we're going to talk about Bitcoin or cybersecurities in general and NFTs, which are now offered as investments. But are they really? Are they currencies? Are they investments? What are they? And we'll also talk about what's a blockchain. It's a database. Those of you who know about databases, a blockchain is just another database. We'll talk about it a little bit, but I don't want to get too much into the weeds. So we're going to talk a little bit about a blockchain. We'll talk a little about Bitcoin and other cyber currencies. I'll call them a currency, but they're really not in my view. And non-fungible tokens. We'll talk about those too. So let's start with Bitcoin. Bitcoin is about 12, 14 years old. It's a decentralized digital currency that is exchanged via a blockchain, which is a database. It's just like, it's a very special kind of database, but it's just a database. There's nothing particularly unusual about it except the way it's constructed. And for those of you in the Sarasota Technology User Group, you may know a lot about blockchains because you may be into different kinds of databases like Oracle's relational databases and other kinds. Blockchain is just another kind of database. Basically, it's an accounting ledger where cyber currency transactions are verified and stored in a public and immutable fashion. Unfortunately, blockchains are not that difficult to hack, and you've probably been reading recently about hacks. One, if you read the Herald Tribune or the Wall Street Journal in the last couple of weeks, $500 million disappeared of Bitcoin from a blockchain hack. So again, let's focus more on Bitcoin. It's governed by not any physical government or sovereign nation like the US dollar or the euro, but basically it's a mathematical construction, and it's mined with open source software. People have to spend a lot of money on computers and electricity to mine a Bitcoin. But what is a Bitcoin? Is it really a currency? Let's think about it. First of all, very few things can you buy directly with Bitcoin. And think about the other thing. Bitcoin's value doesn't stay relatively stable. Well, the dollar changes a little bit. You might see the value of a dollar change 1/100% a day or 1/10%. Bitcoin, its value can change 5% in a day. So that doesn't strike me as a currency because it doesn't meet what you'd think a currency should have, some sort of almost stable value. And that's not what Bitcoin does. And nothing, as I say, backs Bitcoin. It comes with no government in the story, and the value of Bitcoin is just derived from the greater fool theory. That is, you have a Bitcoin. If you want to sell it, you have to find someone to buy it, and you hope they're willing to pay you more than they are now. And Bitcoin, think about it, say a lot of people try to compare Bitcoin to gold. Gold has values. Aside from jewelry, gold is used in industrial, it's used in dentistry. Gold has stuff you can do with it, which helps determine its value beyond just the greater fool theory. Bitcoin has no use. Now, some people say the real use of Bitcoin is for people who do sex trafficking, or people who do drug trafficking, or people who want to avoid taxes. Well, that's not quite the same as gold. Gold at least has some physical use. Bitcoin doesn't. Bitcoin is simply a construct, and its value is set by what someone's willing to pay for it, and not whether a lot of people need gold teeth or gold jewelry is selling well or what have you. But one thing that helps perhaps set the value of Bitcoin is there are only going to be 21 million Bitcoins theoretically available. So at some point, scarcity of Bitcoins may help set its value. However, that's different than gold, of course. Gold is continuously mined. And as far as we don't know, I mean, at some point, theoretically, there's a limit to all the gold in the world, but we don't know where that is. Whereas we do know with Bitcoin is exactly 21 million Bitcoin will be available. They've not all been mined yet. They may never all be mined, but there are theoretically a maximum of 21 million to be available. So Bitcoin isn't an investment really, because this doesn't give you, investments give you either income through dividends or they pay you interest, or the company buys back shares or what have you. So your value of your investment increases and you get something out of it. Bitcoin is not an investment. It's not a currency because it's not stable enough to be a currency. Bitcoin is basically a speculation right now on the future. And for most people, that isn't a prudent investment. The other thing to keep in mind is Bitcoin isn't the only digital currency. Based on an article that was published recently, there are 10,000 others. You've heard of Ethereum, you've probably heard of Dogecoin and all sorts of others, but there were 10,000 of them. As I said before, I want to cover this very briefly. I think this is something that if the Sarasota Technology Users Group, since they're so into computing, this is something they may want to cover alone in a separate investment, understanding blockchain, if you haven't already done that. It's basically a type of shared databases. Most of us, when we think of databases, think of a relational database or something like that. It's different. And I'm not going to go into all the differences other than it is formed, it's called a blockchain because it's formed by blocks of data. And when a block is filled up, that block is then sealed and immutable, and another block is added on. That's basically the difference between that simply in a relational database. And different kinds of information can be stored in a blockchain, but the most common use so far has been as a ledger for transactions. And Bitcoin, information about Bitcoin is stored in a blockchain. I don't want to go any more into that. And as I said, they're immutable. Once a block is filled, it's immutable, which means that the data entered is irreversible. For Bitcoin, this means that transactions are permanently recorded, and importantly, they're viewable by anyone. You don't know who personally owns that transaction, but it's viewable by anyone. Let's talk a little bit about NFT, which was mentioned, non-fungible tokens. This is an interesting thing, also not an investment in my view, but it is an interesting idea. They're unique, identifiable cryptographic tokens that exist on a blockchain and cannot be replicated. Unlike a Bitcoin, one Bitcoin is the same as any other Bitcoin. One NFT is not the same as an NFT. They're not interchangeable. They're not fungible. NFTs can be used to represent real-world items like an artwork or real estate, but also media such as photos, movies, or anything. For example, I don't know how many of you follow basketball, but there's a very good basketball player called Stephen Curry, and he makes amazing three-point shots. So what happened was they took his sneakers and they formed a digital representation of his sneakers, and they sold NFTs that gave you the right to see this digital representation and to use it. For example, if you had an avatar someplace that allowed you in a game to put sneakers on, you had the right to put these Steve Curry sneakers on your avatar. Originally, these sold for $333 for this NFT. Some people have used NFTs, where you have an original work of art, you take a picture of it, and then you sell NFTs, which give people the right to look at that piece of art or maybe own a piece of it. You may sell them for a lot more. Some NFTs have sold for millions of dollars. Steve Curry's was like $333. But basically, it represents some kind of tie to the object, which can be a real object or can be just a computer object. Think of NFTs as a digital certificate of authenticity. So when you tokenize this with an NFT, you can actually sell it. I can sell you the right to use Steve Curry sneakers by selling you the NFT that represents those sneakers. Or if there's a work of art someplace that have been digitized, I can sell you the right to look at that work of art by selling you my NFT. And you might also own a piece of that work of art. And that if the work of art goes up in value, your NFT may go up in value. I'm not a fan of NFTs as an investment tool. If there's something you really like that's represented by an NFT, sure, buy one. Just the same way if you walk into an art gallery and you might buy a work of art. And most people who buy works of art, unless they're really famous Van Goghs or something like, don't expect to have those works of art become investments. They're there for their viewing pleasure and entertainment. Best way, I think, right now to think of NFTs is the same way. I got to skip that. That's enough on NFTs, I think. So let's think about this. My view of the new technology is that it will generally advance our society in some way or another, especially NFTs, I think. For example, you could see NFTs representing your house. And instead of having a complex real estate transaction, you just sell them the NFT that represents your house. Now, you can't do that today, but in the future, who knows what NFTs will be useful for. But again, they're not interchangeable. The NFT that I would sell you representing my house isn't the same as the NFT if you have a house that you would sell. As opposed to Bitcoin, one Bitcoin is like another. As I said, these are interesting technologies, still relatively in their infancy, and I don't think prudent investors should be investing in them. I know I've talked to some people who told me, well, I bought Bitcoin when it was $100 and it's now $48,000. I'm a Bitcoin millionaire. But there are others who bought it at 55,000 and it's now 40-something thousand. They're not Bitcoin millionaires. And that's the point. You have no idea what a Bitcoin is worth. And plus, there's no way to tell. You can't say, well, it pays me a dividend of 5%, so therefore I can analyze what it might be worth. Or its interest rate is 3%, therefore I can do something. Simply, you have to guess what someone would be willing to pay for you a Bitcoin in the future, and whether the scarcity value of the 21 million, if they ever get there, will influence that value. I don't view those things as investments. And also, you have to keep in mind that the current Bitcoins may come into competition with a US dollar Bitcoin, or whatever it would be called, a US dollar cyber coin. And people who may no longer want Bitcoin, the current Bitcoin, if they can buy something backed by the US dollar cyber coin. So who knows? Again, it's not an investment. It's a speculation, and it's not one I would speculate in, but everybody has a right to do what they want with their money. NFTs currently have all the attributes of Beanie Babies. Those of you like me, if you're old enough, remember when everybody had to buy Beanie Babies and they skyrocketed in value. But then they collapsed in value because the fad was over. But in the future, blockchain technology may well render the digital representation of physical assets as a useful and efficient means of tracking and improving business processes, not only the currency transactions. NFTs may become mainstream one day. Right now, they're an oddity. If you see something, if you want to own a pair of Steve Curry's digital sneakers, go to it. I don't know what the current Bitcoin sells for. As I said, originally it was like $333. But view it just like you would as a piece of art. Those of you who have taken cruises find they're always selling you art on cruises. You don't really expect any of that art to go up in value. You buy it because you appreciate it and think the way it's useful to have in your house or whatever. Think of NFTs the same way. So let's go back into what I consider more mainstream. How has the pandemic affected investing? That's what I want to talk about next. So look at the potential impact of the current financial environment, which includes the pandemic, the war, and the Fed on investment methods. We'll look at interest income, such as bond interest payments, which I've already done a good deal of. We'll look at dividend income from stocks, and we'll look at investment in and sales of securities. We want to look at these things and see what is going on and how interest rates and the Fed and the war may have changed things. Okay, what we've been the benefits of if we're a bondholder is for the last 35 years, interest rates have declined. And as I said before, when interest rates go down, what happens? Bond prices go up. But right now, we're going to see a change. Interest rates are going to increase. Now, how much they're going to increase to, neither you or I know. We know what the Fed has been saying, and that's the short end. They've been saying that they're going to increase the Fed funds rate. And most people are betting by the end of this year or next year, the Fed's fund rate will be close to 3%. So that controls the short end of the market. But on the long end, the Fed also has a $9 trillion balance sheet, and they're going to be cutting that down. That means they're going to be taking money by letting these bonds roll out as they expire. They'll be taking money out of the economy because they'll be essentially selling their bonds back. So interest rates at the long end will probably be going up too. So let's see what happens in the current environment with the Fed changing its policies significantly over the next few years. Now, this slide isn't quite up to date, but let's look at a bond, a $100,000 bond at 2.23%. Maturing in 30 years. As I said on an earlier slide, the interest rates are going up now. That's probably closer to 2.7, 2.8% now, but it doesn't change things dramatically. If the interest rates for the 30-year bond go up from its current 2 point something percent to 5 or 6%, the value of a bond that you bought at 2.23% would drop dramatically. If it went up to 5%, your value would have lost 43% about of the value of your bond. That meant if you tried to sell it, you would have lost 43%. If it had gone back up, you may remember, in that earlier slide, interest rates got 7-8% before in the 80s. You would have lost 2/3 of the value of your $100,000 bond if you had to go sell it. Now, if you could hold it to maturity, you would have certainly gotten back the $100,000. I'm not one of those people who believe the government won't pay its debts. I'm optimistic the government will pay its debts. But the question is, what will you be able to buy in goods and services 30 years from now with that bond? Well, probably this reduction here that you see here is a reasonably accurate reduction of its purchasing power. So if you held this bond for 30 years, you would get your money back, $100,000, but it might only buy $50,000 worth of stuff or less at the prices then. So the change in the Fed over the next few years and inflation, which is going up, as you saw, 7% for 2021, 7.9% through February or March. I think it was through March. You can see what's going to happen is buying a long-term bond like this is not suicide, but say a questionable decision at least. And again, I'm just repeating, you may have been told that such declines would only be paper losses if the investor doesn't sell the bond. But these paper losses may accurately reflect the very real impact of higher inflation on the eventual return of principal and future interest payments. Keep that in mind. When you buy a long-term bond like a 30-year Treasury bond, the interest you get each year is fixed for the whole 30 years. So if interest rates go up, the value of your bond will drop, because why would someone buy your bond for the same price they could buy another bond from the government, which pays a higher interest rate? Your bond would have to fall in value so they would be made whole. And of course, the longer the bond maturity, the greater the interest rate risk. If rates rise, we must expect lower interim market values for your bonds. It's an unfortunate fact of life. For the last 35 years, it hasn't been a bad deal to hold bonds for most of that time. For the next few years, and for how long longer than that, I don't know. But it's questionable at best. So in the current interest rate environment, we do not recommend that investors own intermediate term or long-term bonds. And we don't recommend that investors ever own junk bonds. It's just not a prudent investment. And the reason for not intermediate term and long-term bonds is we will be very surprised if they don't fall significantly in value over the next few years because of rising interest rates and inflation. That doesn't mean you can't own bonds. Short-term, high-quality bonds maturing in a year or two are fine, because then if interest rates go up, your bond will mature and you can quickly reinvest it at the new higher interest rate. And because they're high quality bonds or treasury bonds, there's no risk, a real risk of default. And so you don't take any risk either from interest going up or from default. And those are the things you want to avoid in bond investment. And in the current environment, short-term, high-quality bonds are okay. Longer-term or intermediate-term or junk bonds are a bad idea. And to reiterate a point, such bonds subject their investors to the risk of irrecoverable purchasing power losses. Because I don't think we're going to see deflation. I'm not an oracle by any means. So as long as there's inflation and high interest rates, your bonds lose irrecoverable purchasing power, and maybe if you had to sell them in the short term, not only that, but actual principal value. So let's look what happens to someone who's, in my view, imprudent. Suppose they say, US government bonds are perfectly safe. I'm going to put my $1 million and I'm going to invest it in a 30-year US bond, treasury bond, absolutely safe, no risk of the default, and I don't want to take any chance on the stock market, its volatility or anything. I'm putting it in there. And let's go back to that same 2.23% yielding US treasury bond. And since we don't know what inflation is going to be over the next 30 years, I picked the historical average inflation rate, which is 3.2%. Remember, now inflation is running 7.9%. A few years ago, it was 1.6%. I have no clue what it's going to average over the next 30 years. So I thought the best thing to do was to take this long-term historical average of 3.2%. So let's look at someone, they decide, hell, I don't want to worry about the stock market or anything else. I'm putting all my money into a 30-year treasury bond. All right, and suppose they follow the guideline, again, which I think is outdated, and I'll talk more about that if anybody wants to know, of 4%, taking out 4% of your initial principal and then increasing it by inflation each year. Let's see what happens to the poor couple or guy. The first year, he's got $1 million. Because it earns 2.23%, he gets $22,300 in earnings, but he needs $40,000 because he says he's going to take out 40% of the original value. So he has to sell some bonds. That leaves only $982,000 in actual principal. Forget about for now what the inflation adjusted value is, just the principal. But now he only has $982,300 generating interest. And so he gets not $22,300, he only gets $21,905. But because inflation was 3.2%, he now needs $41,280. So he's got to sell more bonds. So now he's only got $962,925. Similarly, year after year, this is what happens because his interest rate is fixed and inflation is running at higher than his interest rate. So his principal keeps falling. Principal keeps falling, and the inflation adjusted value of his principal falls even more. But look what happens. By year 15, half his money basically is gone in nominal terms, and in inflation-adjusted terms, over 2/3 of it is gone in purchasing power, perhaps. And by year 23, he's bankrupt. Now, this is not a totally realistic example because they might cut their spending, who knows? But this is just shows you the risk of, in an inflationary environment, investing in a long-term bond. And don't think to yourself, well, 23 years from now, I won't be alive. You might well be. The average 65-year-old healthy male will live till like 86 or 87, and the average woman will live a couple years longer. And a healthy couple has something like between a 25 and 50% chance of one of them living into their 90s, usually the female, but one of them living into their 90s. So you might well live a long time if you retire at 65 beyond 23 years. So this is not a totally realistic example, but it is an example that shows you the difficulty of basing your retirement on a long-term bond investments. So let's talk a little bit about the reality of how you can pay your bills. We'll talk a little later about how you grow your money, but let's talk a little bit about how you pay your bills. Unfortunately, I wish I were an oracle. In today's market, we need to accept there's no really fully satisfying answer. I can't give you a saying that says if you do exactly this with your portfolio, you never have to worry about money. You'll never have to worry about working in the golden arches in your golden years. I have no answers like that, and I'm telling you, nobody else does either. Anyone who offers a no-risk, high-return investment is not revealing all the risks and likelihood and costs. If someone comes to you and says, I have a 10% return investment, it'll guarantee you 10%, has no risk to it, and it's all your money, don't talk to them, just leave. It's not a real investment. It's a scam of some kind, or they're lying to you or misleading you about the risks. So unfortunately, we're not going to give you a traditional solution, namely proposing a stock and bond blended or balanced portfolio. And as I've hinted, or more than hinted, that we will not jump on the bandwagon and tell you should be in Bitcoin or NFTs. The reason you're not going to want to be in a balanced portfolio is, as I mentioned earlier, right now, a 60-40 portfolio is not a good place to be, because with bond interest rates going up, the value of your bonds will fall, and it won't provide any help if the value of your stocks were to fall too. So a 60-40 portfolio, which has been one of the guidelines in a rising interest rate environment, is probably not as prudent as you would like it to be. But we won't leave you at sea. We will give you what we think is a reasonable option in light of the current market environment. But I want to emphasize again, as we've seen, unless an investor has an exceptionally large portfolio, for example, if you have $100 million and you're spending $200,000 a year, there's pretty much nothing you can do that will run you into trouble. But there aren't probably many of you here in that situation. Or unless you have minimal spending needs. I mean, suppose you're particularly frugal and you don't spend very much money, then you might be able to get by with a fixed income portfolio. But in general, that's not the answer. You're not apt to cover living expenses without depleting principal, or at least sacrificing the portfolio's purchasing power, which means sacrificing your standard of living. That's reality number one. And again, I'll emphasize, I said it again, I don't want to beat it to death. This is not the time to put your money in any significant amount of it into Bitcoin or NFTs. It's just, these are not real assets. Again, I'm saying this, I'm beating it to death. Investors who have traditionally invested the bulk of their money in fixed income securities to pay the bills may need to consider changing the way they invest by adding either common stocks or more common stocks, depending on where they are today. Again, I keep saying this because I'm concerned. I've met some people who are betting their futures on Bitcoin. They tell me it's a foolish thing. They're putting it all into Bitcoin. In fact, I talked to someone recently who put their IRA into Bitcoin, which I didn't even know was legal. That's not something I think you should do. It's something you shouldn't do, actually. They just don't have a track record of consistency or quality and any predictability. They shouldn't be, this says on this slide, a core component of prudent investor strategy. I don't think they should be any component of a prudent investor strategy. I think I could use a little sip at this time. So if the moderator would help me out, if there are any questions, I'm willing to answer questions about anything. It doesn't have to be about this talk so far, anything but an individual security. I won't tell you my view of Tesla or something like that. But if you want to ask any general question about investing or about what we've talked so far, I'll be glad to answer at this point before I go on.
Joseph, got one question.
Please go ahead.
Yes. What is your feeling about investing in annuities?
There are lots of different kinds of annuities. Do you have a specific kind of annuity you're thinking about?
No, any kind.
Any kind.
Well, the simplest kind of annuity is what's called a fixed annuity or single payment annuity. You give the insurance company money, like $100,000, and they guarantee you a certain amount per month for the rest of your life. That's a very simple annuity. It's fixed because you get that same amount of money for the rest of your life. And different annuity companies pay different amounts. For example, one of the ones that I follow is the Pomona one. If you're 70 years old, a male anyway, in fact, it may be both males and females, I don't recall now, I think it is. At 70 years old, they'll pay you 7.5% of the amount of money you give them. There's some minimum for the rest of your life, annually, divided by 12 for your monthly payments. If you're 80 years old, I think they give you 10%. That's the simplest kind of annuity. And for some people, it makes sense, especially when you're older, because then the older you are, the less you have to worry about inflation. If you're 80, 85 years old, inflation probably is not a big deal to you. And so an annuity is fine. Now, there are annuities also like that that have inflation protection. They pay you less, obviously. So, and of course, if you have a joint annuity with your spouse, so that when one of you dies, the other still gets payments, they give you even less. But a single life annuity, from somebody like Pomona is the highest one I know about. There may be others, I don't know them all, will pay you at 7.5%. Now, they're also called variable annuities. And that means that basically they're like mutual funds hidden inside an annuity wrapper. And I'll talk more about those later, but I don't recommend them for most people. So if you want to ask me a little bit more detailed question, I'll be glad to help you out. But without you asking me more about what kind of annuities you're interested in, what your situation is, I don't mean details that you want to share over this kind of stuff, but something more specific, and I give you a more specific answer. But that's a very general answer for you. There are fixed annuities, single payment annuities, which are not bad for people who are older. And there are variable annuities, which basically have hidden inside them mutual funds. And I'll talk a little bit about why they're not such a good idea later. But is that helpful? Would you like to know more, or would you like to wait a while?
That's good.
Thank you very much for the question.
Judith is next with a question.
Please.
My question has to do with the war in Europe and whether you see any particular impact on the financial markets other than the instability and the rise of inflation.
Well, certainly the instability. You have to expect a great deal of volatility. Right now, I follow the market very closely because of my business. Right now, you see the market go up or down based on things that Putin says, or based on things that Zelensky says, or based on whether the Ukrainian forces have taken back a town, or they've lost a town, or something's blown up. And so you have to expect the market to be very unstable in the short term. You have to be willing to live with the volatility. Now, the long term I'm very confident about the long term, but the long term may be 3 to 5 years. So one has to have a perspective of 3 to 5 years, and one has to rule out the possibility of nuclear war, in the sense that if there's a nuclear war, it's not going to matter where your money is.
Good point.
I mean, but if we rule out nuclear war, then at some point in the next few years, if not sooner, there will be some kind of resolution to the Ukrainian-Russian war. And based on how that resolution is, will determine a lot about the financial markets. Right now, what we're seeing is we have to expect higher inflation, and we have to expect shortages. Because keep in mind that Russia and Ukraine together are responsible, like, I don't know the exact number, maybe one of you does, 30 or 35% of the world's wheat or grain. And they're responsible for a certain amount. Russia provides, I don't know exactly, 10% of the world's oil or something like that, and gas. I don't know the exact numbers. And to the extent that the war goes longer and the sanctions get worse, you have to expect more and more problems.
7:30, and the library closing in 30 minutes.
Thank you.
Margaret, somebody's speaking. I think it's in the hall. Margaret, you have a question.
All right, I do. Thank you very much. That was a great.
Let's try to keep it to one at a time. I appreciate it.
All right, but there's somebody in the hall with a microphone. Anyway, I'm letting you know that it was an excellent talk. Thank you very much.
We're not finished with the talk. This is just the question.
Right. One question is, what about the future sectors like green energy and batteries? And I mean, that's the green energy, but water is another, the actual delivery of water. So my question is, what do you see like those kinds of portfolios? Are there ETFs in that area?
There's certainly an ETF in the water, and there's certainly ETFs in the energy industry, and there are ETFs, general commodity ETFs.
Okay.
It depends. I mean, one might guess that those, and we guess correctly, have gone up quite a bit in value already.
Right.
So you might be buying close to the top at this point. I don't know. Just think about all those people who bought into GameStop, and it went from, I don't know, $5 a share to $200, and then it went back down. I mean, I don't know what's going to happen. In the short term, commodities are probably fine. There's going to be shortages in oil. There's going to be probably shortages in grain and things like that.
But I'm thinking it's going to kick solar up. I'm thinking some of those shortages would help us in the green energy with wind and solar. So
they might. But
Yeah.
you have to understand what's also going on is tariffs. The U.S. government might be placing tariffs on Chinese solar stuff, and that might cause the
That's
market.
perfect. It'll build our market again.
It might or not, but the point is our market will raise its prices because of the tariffs, because they won't have to compete so much with low-cost Chinese things. And the other thing you're probably aware of if you live in Florida, I don't know where you are, is I think they passed the law, but I'm not sure.
Not yet. It's on the government.
Where they're not going to allow net metering. So that means...
Yeah, Robert, it's on the governor's desk for signature. It has not been signed, but it
okay.
It has a lot of people that are upset about it because we use solar a lot.
Right, but does the governor care about those people? I don't know.
It's 40,000. It's like 45,000 people that are working in the industry in Florida.
Well, one would hope that they'll continue to allow net metering, but I can't predict what the governor is going to do.
No, and not this governor, yes.
Yes, and I can't predict whether the U.S. government will put significant tariffs on Chinese solar cells. So no. I don't know. I think in the short run, it's hard to tell. I happen to like water as in general. I'm not going to mention any particular water stocks, but I can't see, given the climate change, how there won't be a shortage of water in certain parts of the world. So again, I'm not recommending that as an investment. I'm just saying that's one of the ones that seems perhaps not yet fully valued. I'm not sure about oil ones and things like that.
Thank you very much.
Okay. Are there any more questions, or should I continue pontificating?
Yeah, Bob, before we do that, I'd like to ask Ann in the hall, what time do we have to end the presentation?
We have to be, we need to be on sort of packing up and getting out in about 10 minutes.
Okay, that'll give me my full hour, because remember, you guys used a good part of that at the beginning.
There was two questions in the chat box. One is, how do you spell Pomoda?
How do I spell what?
Pomoda, that you mentioned something about an annuity or something, Pomoda?
There are different kinds of annuities. There's a single payment annuity, and there are variable annuities.
You used the term Pomoda somewhere. I remember hearing that, but I don't remember how it was. And they just want to know how you spell that.
I don't remember using that term, so I apologize. I just don't remember.
Okay, and then what about
Pomona?
Pomona. Oh, Pomona, P-O-M-A-N-A. That is a university conglomerate in California that also has annuities. Pomona. Okay. Look up Pomona plan on Google.
And then what about gold stocks or gas stocks?
Again, gold is a hedge investment. There's nothing wrong with someone having a very, very small part of their portfolio in a hedge investment. If they like gold, that's fine. In the short term, gas stocks are probably going to do well. But again, I don't invest mostly for the short term. I'm more of a long-term investor. So you have to decide whether right now gas is going up dramatically. It might continue to go up dramatically because of the war. If Europe tries to cut gas out of Russians' exports, then that gas has to be made up from someplace. It'll be made up from liquid gas in the United States, which will push up the price of gas, which will allow gas stocks to make more money. Again, you have to decide what you think is going to happen to Russian gas. I don't have a clue what's going to happen to Russian gas.
Terry Ann had a question, and then we'll let you finish up.
Last question, let me finish up. Go ahead, please.
All right, thank you so much. Just a very quick question. Do you recommend that someone who has a 60-40 portfolio, some of which is in short-term bonds and some of which is in long-term bonds, that person just hold what they have? Because this has been recommended by some people to hold and just stick it out. Thank you.
Well, I don't think long-term bonds are going to go back up in value anytime soon. I think short-term bonds are fine. If you have short-term AA or AAA bonds or U.S. Treasuries notes, that's fine. I would not own 10, 20, or 30-year bonds right now. Now, whether you should sell them or not, if you have a financial advisor, you should discuss the pluses and minuses with that person. I would not, if I had a client come in now, I would not let them prevent them if they demanded it. But I would strongly recommend that they don't buy any bonds with more than a 2-year or so maturity. But if you have already bonds, long-term bonds, and you have a financial advisor, then you should discuss with them the pros and cons of selling those bonds to avoid further price fall. And maybe your advisor doesn't believe the bonds interest rates are going to go up, in which case that's different. I believe interest rates are going to go up, and that's going to affect bonds values. And the longer the maturity of the bond, the more it's going to affect the value. Okay, why don't I move on at this point? Let's look at quickly, I've got maybe 10 minutes, I'll do it. Potentially higher total returns from a common stock portfolio. Over time, total returns will likely be higher than bond investments. Over the 50-year period from 1972 to 21, stocks returned more than 10% annually on average. But prudent investing suggests assuming more moderate returns in the years ahead. Stock returns tend to be inversely correlated with previous returns. So if you have a decade or two with very high returns, then you expect the next decade or two to have lower returns. I don't predict what those returns will be, but I would be surprised if we average 10% or more over the next decade. Doesn't mean they won't, I'm not an oracle. But with a stock portfolios, investors can benefit from both dividends and capital appreciation to meet their retirement spending needs. I'm going to go faster than I normally would because I know there's a time constraint now. From a common stock portfolio, you can realize taxable gains, and you can put off realizing them also forever. And if you die, the basis will be stepped up under current law, and no one will pay for those capital gains. In taxable accounts, long-term capital gains and dividends are generally taxed lower than interest income. Right now, no matter how rich you are, basically the top you can pay is 23.8% versus whatever the top bracket is these days, 37 point whatever. In fact, if any of you here are in low tax brackets, which means that your total income for the year is in the low 80s after deductions, including your capital gains, long-term capital gains and qualified dividends, you don't have to pay any taxes on either of them, which isn't true for bond interest. So if someone has, after deductions, $80,000 of income, including capital gains and qualified dividends, there's no tax due on those. And that doesn't take that much because a married couple gets, if they have $100,000 or $110,000 of income, after deductions are probably down in the $80,000 range, so they probably will pay no taxes for capital gains and qualified dividends. But if they have bonds, they'll still pay the taxes on the bond interest. Okay, again, stocks, unlike bonds, can be a hedge against inflation. Over any reasonable period of time, stocks have outpaced inflation. Stock dividends, the dividends from common stocks tend to also outpace inflation. Over 3 to 5 years, they rise faster than inflation did over those 3 to 5 years. Inflation, as you know, in 2021 was the highest recorded in the USA since the early 80s. So you have to keep in mind inflation now as a necessary part of your investment strategy. There are bad sides of a common stock portfolio. The most important one is stock investors give up the certainty, timing, and magnitude of their potential returns. They don't know anything about them. You put $100,000 in a one-year CD today, you can get 1% if you shop around. So you know you're going to get $101,000 back a year from now. Put $100,000 in the stock market, you don't have a clue what it's going to be worth a year from now. So that's the downside of a common stock portfolio. You just don't know anything about any short-term future value. But the upside is this, or the balancing is, certainty of returns come with certainty of low returns. So if you buy something like a 1 year, even a 5-year CD, the last time I checked, if you were lucky, you got 1.5%, 1.6%. You really want to loan money to somebody for 5 years when inflation is running 7% and getting 1.6% back? I'm not going to talk about sequence risk. I don't have enough time. I'm not going to talk about this either. I will point out that the older you are, you should be more open to spending from your principal if you have to. If you're 55 and early retiree, then you probably don't want to. In your 80s, rather than compromise your standard of living, you probably should be willing to prudently spend some of your principal. And of course, if you own higher dividend paying stocks, you might not have to do that. Let's summarize quickly. bonds alone in today's environment are not going to be enough. While they give you safety of principal, if you buy the right kind of bonds, they pay you minimal income and no inflation protection. But if you add common stocks, you get higher income and appreciation potential, no short-term, but it has no short-term safety of principal, but you do get in the long-term inflation protection in general. But the importance of you investing in today's world is you have to have quality investments. And we're going to talk about why. You want to ensure the securities of your portfolio meet rigorous quality standards, but you don't want them to go bankrupt. I mean, for example, General Motors, I could name Lyondell Chemicals, Fannie Mae, a whole bunch of stocks in 2007, 8, 9 went bankrupt. And again, during the pandemic, a whole bunch of stocks went bankrupt. You don't want to own stocks that might go bankrupt. So what does that mean? Your bonds should be short-term and they should be rated A or better. That's what your bond portfolio should be. 1 or 2 year maturity bonds, all rated A or better, or US Treasury notes. Stocks should all be high quality. The bulk of your portfolio should be in high quality stocks, A- to A+ rating, say from Standard & Poor's. There are other ways to get to high quality, but one of the ones I use is the S&P ratings. So if your focus of your portfolio is on high quality stocks and high quality bonds, you'll do well. In the long run, nothing in the short term, you're going to be open to volatility, but in the long run, you'll do well. So this isn't your parents' retirement income. When my father was retiring many years ago, he was able to get 1 year CDs in a low inflationary environment. You were paying 5 and 6%. You can't do that now. So low income yields and longer life expectancies are pressuring many investment risks to meet living expenses. Don't take risks if you can avoid it. And keep in mind what we've just seen. Economic climates can change unpredictably, quickly, and significantly. Remember, 2 years ago, interest rates were negligible and inflation was 1.6%. So you have to ensure that your portfolio is positioned to weather the storms, but still thrive during good times. And a well-constructed dividend-paying stock portfolio can do that for you. So I'm going to finish up quickly, and then I won't go through all of it. I just want to talk about some of the rules of investment success. Buy individual bonds and stocks. Avoid mutual funds, ETFs, and variable annuities. If I have more time or people want to ask questions afterwards, I'll go into why, but I know that we're running late. Quality matters. You want to invest in only high quality securities to minimize your chance of an irrecoverable loss. You don't want to own stocks that may go bankrupt or bonds that could default. And you don't want to time the financial markets. There's no academic study that shows that anyone is good at consistently and correctly predicting financial markets. You want to have a consistent investment strategy. You want to know why you're buying. Okay, it's time to stop. All right, I appreciate you spending time with me, and I'll stay here for a few minutes.
Thank you.
If anybody wants to ask questions, I'll stay online for a few minutes. But
yeah, I was going to suggest let them finish up in the hallway, and then we can stay. Anybody online, if they have some questions for you, can stay.
Yeah, I won't do any more of the presentation because it would take a while, but I'll be glad to answer any questions.
Okay, Ann, go ahead, take it over.
Thank you. Thank you so much, Dr. Stepleman. We certainly appreciate what you had to say to us tonight. And
well,
I'm assuming that
appreciate you guys listening to me.
And I assume that any of us can come and see you somewhere in Sarasota. Is that right?
Right. You can all email me at robert.stepleman@dow.us. Let me see if I can quickly get to that slide and go past these other things and get to the
We will surely put that up on our website, so don't worry about it. We will get that
those of you, you can call me at our office number, or you can email me at robert.stepleman@dow.us. So if you have some questions afterwards you didn't get a chance to answer, just get in touch with me. I'll be glad to answer your questions.
That's fantastic. And so for us who are here in person, we are the ones who have to leave you because the library is closing. But I just want to tell you that we did have a drawing tonight for a free year at STUG. And the winner happens to be the very man who is driving me home, and his name is Jim Cerny. So congratulations to Jim, and thank you again, Dr. Stepleman.
Thank you all for allowing me to pontificate.
We're going to be leaving.
Okay, everybody in the hall, thanks for being here. Anyone online, if you want to stay and ask questions, we can continue online without any problem.
I'll be glad to stay for a few minutes if there's questions.
Okay. Mike, thank you.
Okay, bye-bye.
All right, any questions from the audience online? There's still several of you on here. Terry Ann, you have a question.
Revisit on that 60-40, sorry. You were saying don't buy, but if you have 40% of your portfolio in bonds and you've already lost, say, 10%, should you sell and take the loss and go ahead and buy into the stocks, or do you think that you should hold and just continue the loss, especially if you're around 70 years old? Thank you.
Okay, again, if you have a financial advisor, this is a question you need to discuss with him or her in detail, because she knows you better than I do. He or she knows you better than I do, knows what your other situation is. But the fact that you've taken a loss doesn't change anything. What you should be asking yourself is, would I buy this today? Is this a good investment for you to make today? The answer is no. Depending on your tax situation and other things, it might be better to take the loss and invest in something that is a good investment today. Now, again, if your financial advisor doesn't believe that interest rates are going to continue going up, they may tell you, no, hold on, because we've seen the peak of interest rates and your bonds will be fine. It also depends how long to maturity your bonds are. If they're 4 or 5 year bonds, it might be different than if they're 10 or 20 year bonds. So again, this is a question that the way I look at it is, would you buy those bonds today, given the best?
They're actually ETFs.
Well, it doesn't matter if it's a bond ETF. Would I buy that bond ETF today, depending on what it is? I don't know what, there are lots of different bond ETFs. I know the one that follows the broad bond market today is down about 7% as of yesterday. Different ones are down different amounts. So I don't know exactly which one you own. And even if you told me, I wouldn't know off the top of my head. But the broad one, the last time I looked yesterday, was down about 7%. And the question is, you have to ask yourself, would I buy that today, knowing that, not knowing, but suspecting that interest rates are going to continue to rise? And if you have a financial advisor, just ask them that. Forget about what I own now. That's a sunk cost. I've lost the 7% or whatever it is. Now, if I were coming to you today, would you tell me to buy that ETF? And if his answer is yes, then maybe you should hold it because he knows you better than I do. If his answer is no, then I would sell it.
Okay. Question on the 4% rule.
Yeah, I don't believe in the 4% rule. What I tell my clients is that as a guideline, you have to look at how much money you're going to need from your portfolio over the next few years. In other words, after you take advantage, after you know how much you spend roughly each year, and you know how much you're going to get from guaranteed things like Social Security, and if you have a pension or whatever, then you have to ask, in addition to that, how much am I going to need each year? Then my guideline is that you have something between 2 and 4 years of that amount of money in cash and short-term bonds, and the rest in stocks. And then you just withdraw what you need from your portfolio. You forget about 4% rules. You withdraw what you need from your portfolio with some reasonable limits. And it's not 4%. It might be 5%, depending on what your asset allocation is and depending how old you are. The 4% guideline is a very rough guideline. It might make sense in many cases for someone who retires at 55 or 60. It doesn't make sense for someone who's 80. So it's a more complex question. The 4% is a rough guideline. What I tell clients is forget about the 60-40 portfolio and forget about the 4% guideline. You put as much money in bonds as you need to pay your bills after all your other things for the next few years, and the rest is in stocks. And then we discuss, depending on your age and other issues, how much you can take out every year. And it depends basically on your age. The older you are, the more you can take out every year in general. But it depends on your tolerance for risk also, because your portfolio is going to fluctuate. So, and also more and more people are leaning to the idea that your withdrawal rate should be dynamic, in the sense that if the market drops, you don't increase it by inflation, or in a severe case, if the market drops a lot, you lower your withdrawal rate, or if the market goes up by less than inflation, you don't increase your withdrawal rate. So this is a question that you should discuss in detail with your financial advisor, because they have to know more about your situation to give you a really definitive answer. But in general, forget about the 4% rule.
Bob, thank you very much. It has been a very interesting discussion. One of the comments was good presentation. Can we get a copy of the slides?
Well, you have the slides. You recorded the thing. So
yeah, but somebody may want this a PDF of the slides, if that's possible.
It probably is, but you'd have to make a formal request. I can't do that without the agreement of Dow. So if someone wants to send a formal request, then I can forward it to Dow, and then they can decide what you want to do about it.
Okay, and that's an answer to what somebody asked in the chat box. Again, I know they had to pack up and leave at the library, but for those of us who've been online as well, thank you very much.
We appreciate the time you spent with me.
Okay. And so for everyone, we're going to go ahead and end now. And thanks for attending. And I hope you got something out of this. And we'll see you next month.
All right. Bye-bye.